Okay, everybody, welcome back to the 4-Star Podcast. This is now we're into the next 100 episodes. We just had inked our 100th episode. So now we're on to 101. 102 is coming out shortly as well. So it's Brian Kasal. I'm back with Mr. Christopher Reardon. Chris, welcome to the podcast.
Thanks, Brian. Glad to be here. Happy to talk about markets.
All right, and same here. Chris. Let me describe Chris. He's our 4-Star Director of Development, master of all things portfolio. Loves his Cleveland Indians, caretaker of his golden doodle puppy Hudson, and new daughter Avery. Congratulations!
Thank you.
And I'm Brian Kasal, founder and CEO of 4-Star Wealth Advisors. I'm an Eagle Scout, a trustee of the National Boy Scout Foundation. Philanthropic advisor to CEOs and insiders, chief dad to Evan and Quinn, and the husband to the amazing Tripty. If you like what we are doing, please give us a 5 out of 5 on Apple iTunes. We're going to start out today with our discussion of markets, the economy, and what we see out there. You know, Chris, we've seen some interesting changes in the markets, and it seems like money's flowing back to U.S. stocks, and then not to the other risky categories like international and commodities and things like that, right?
Yeah, we've definitely seen some significant changes, especially from the last time we've done the podcast. Domestic equities, like you said, Brian, it did gain 5 points. So we have seen almost a shoring up of the U.S. Markets from a relative strength standpoint. But the 2 and 3 positions, both commodities and international equities, lost. And the biggest loser was international equities in the 3rd position, which lost 21 points. So it kind of slowed down to 215. Some of that could have been in between. We had some news continue to come out of China. You have a lot of supply chain shortages going on. You have oil has been a big concern, especially in gas, really, in the European Union. So, we're seeing just a little bit of slowdown there. Commodities in the number 2 position slowed down. It went down 4 points to 264, so not quite as bad. That's probably even a little bit of moderation with even agricultural. There's so many commodities that play in there. We've just seen that decrease a little bit. And then the bottom 3 asset classes gained. Fixed income gained 7 points. It went to 127. Cash gained 8 points. It moved to 103. So now it's surpassed that 100 level mark. It's back in the hundreds now. And then currencies gained 4. So it's in the 54th position. I think it begs the question, what does this really mean? And, I don't think as it stands now, it doesn't mean a whole lot. I mean, it means maybe you'd say some short-term volatility in international markets. It's promising that domestic equities is going up. And I'd say commodities, even though it's a -4 number, it still is remaining relatively constant. I just think we're seeing some, whether it's geopolitical or other kind of news from the global markets that are just causing them to, show some short-term volatility, which is kind of being displayed here. And I think on the flip side of it too, domestic equities, if you guys remember, this is all relative. Domestic equities have been doing extremely well. So I think some of this could be, the domestic markets pulling away points from the international markets.
Yes. It is interesting. It's just a quick reversal since our last podcast, but unless we see it continue, then it's not much of a trend. But money is definitely flowing to U.S. stocks, had been flowing to commodities and international. So this period, we got a little bit of a breather. And interestingly enough, Chris and I were at a dinner the other night, and we spent some time with Dave Dolly, who's one of the managing directors of Matthews Asia, and he agreed to join us on our podcast. So we're going to be hearing from him what's going on in Asia and some of the Asian markets, traditionally very strong when the economy grows, that all the third markets do really, really well, and they grow faster than markets like Europe and America. But we'll see. And then we'll hear a little bit why there is some weakness in the international markets, and the Latin American market, Chris, is also pretty weak in a couple of weeks, right?
Yeah, that's correct. Yeah, Latin American markets have also had a slight pullback. And I think a lot of these, especially from the international front, you have a lot of inflation floating around now. You have commodity prices skyrocketing. So, there's certain countries that are going to benefit from this, and there's certain countries that are going to get hurt from it. And so, Latin America is a great example of countries that have been hurt from supply chain issues and inflation.
Well, and we've often wondered why anyone would invest in China, because they seem to have command and control responses to anything that the administration there doesn't like. But we did see a softening in the terse nature of the Chinese government with regard to that Evergrande company that started to implode.
Yeah, and I think that's promising. I think, that's been a high tension, I would say a high tension event going on. Is the Chinese government going to let them default? What are they going to do? And their stance has definitely softened a little bit more as of late, and I think traders have definitely made that bet. I think some of the property developers over there have gotten a little bit of a bounce in their stock price, just because the feeling is that they're going to soften their approach. I don't know what that necessarily means in the end game, but hopefully it won't mean outright default or anything catastrophic that could have major global market implications if that were to happen.
But their economy is slowing down, and we saw a really big bump in their PPI, their producer price index, right, Chris?
Yeah, and that's the big news that came out there. Producer price index rose by 13.5%. Which seems extremely high here, but the expectation was 12.5%. So it was still higher than expectations. A lot of this is due to energy prices. There's a thirst for coal there. It's the energy crisis really there, if you will, is really strangling them from a price standpoint in the producer price side. So we're really seeing that feed into the Chinese market. And, I don't know what's ultimately going to alleviate it. I think that in the short term, it's probably just going to stay elevated as energy prices continue to ripple through the global economy right now.
Yes. Well, it's interesting. Now, oil prices have been, rising sharply. And it's just a classic supply and demand thing that's going on here in America. And that's affecting the Chinese economy now. We're going to talk a little bit more about this later, but President Biden restricted the U.S. supply. So if you pull out the basic supply demand chart, when supply is restricted and the curve moves to the left, prices go up. Very basic idea. So he's blaming OPEC, and that's not really credible at all. So we're going to talk a little bit about that in the future and later in the podcast. Chris, there are a lot of interesting numbers that came out from the economy: inflation, groceries, airfares, all those things. Let's go through that.
Yep. Yeah. So the biggest news I would say on the home front was the inflation number that came out this week. It hit a 31-year high. This is the October number. It came in at 6.2%, which was, I think, quite a shocker. It definitely sent ripples through the U.S. markets at the time. The core index, which I think is probably the more important one to look at, because that takes out, more volatile like fuel or gas prices, things like that. It takes out more volatile assets. It was up 4.6%. So still very high there as well. We really saw almost a broad range of increases, including autos, gas, furniture, rent, medical care, food costs. So both on the grocery side and the dining out or restaurant side, groceries are actually up 5.4% from the beginning of 2021 to October. Restaurants are up 5.3% prices. So a big jump there, I would say, on prices. And on the flip side, there were a couple asset classes actually, or different sectors, is probably better, that did decline, and airlines was one of them. So airlines actually decreased 4.6% from the start of the year. So that's really interesting. We're starting to see airlines try to renormalize, try to kind of get their flights back on schedule. And that's been tough for them. I mean, when you deal with a lot of staff shortages and other issues, and then you add in weather and other, things that are out of their control, that's why we've seen, a lot of flight cancellations. We've seen American Airlines, Southwest, a lot of major airlines have had problems. So with that, though, flights, the cost of flights have gone down since the beginning of the year when they really spiked.
Yeah. Yeah, it's interesting. There's so many changes that are going through the economy. The airfare thing might be a sign that the airlines expected more strength by now, and they have too much capacity, so the ticket prices had to come down a little bit. Maybe that's part of it. Home prices, as you said, were still up. And then, the key to that number, we had this discussion about how the average listing time was only 1 week, right, Chris?
Yeah, I mean, home prices, feed into that as well, right? So home prices I think it's been a lot consecutive quarters now. I don't know how many, but they rose 16% year over year for the month of October to 363,700 was the median single family existing home price, and that was actually that's NQ3, so beginning of October. So that's a ridiculously high starting price for a single family home, kind of, if you will, the entry price. And then, like you said, Brian, I mean, even though it's slowed a little bit, which we've talked about before, it's still been a very competitive and a very fast-paced real estate market, with homes only lasting on the market for a week in some cases. So you have a lot of buyers that feel compelled to put in an offer, in some cases put in an offer above the asking price, because they're afraid to get outbid. And I think almost everyone's probably heard a story about, someone who's looking for a house, they get outbid the first house, the second house, and the third house, they just throw out a ridiculously high price because they want to try to, get a house, and they're tired of being outbid. So, I think that will slow down. We talked about how some of the banking people are doing mortgages and aren't just doing all upfront cash. That process is slowing it down a little bit. So I do see it slowing down slightly. It'll still be a hot market, but it, maybe slowing down from how hot it's been as of late.
Yes, interesting. Well, and then the prices in many commodities are rising, including asset prices, homes, stock prices, other things, and increasingly believed to be causing some of that is the money supply. We are going to have a very interesting discussion also on a future podcast with Dunn Capital Management, in which they have an analysis of money supply and money supply and the money velocity. So supply has dramatically risen and velocity has dramatically fallen. So there's so much money out there that's just pushing prices up, and some of it's sitting in banks, but then it's still pushing prices up. Milton Friedman, the famous University of Chicago economist, the father of the Chicago School of Economics, monetarist theorists who talk all about money and money pushing prices around, talked about how inflation is really a monetary phenomenon. It's just purely a supply and demand for goods based on the currency. So if anybody does a YouTube search and says Milton Friedman on inflation, you'll see some of these interesting videos that he did years ago. We didn't even know what YouTube videos were back then, but they managed to get them on some sort of film, right? And so that's out there now. And so he says inflation is inherently a monetary phenomenon. When there's more money chasing goods, and you have the same number of goods, and of course now we're restricting the manufacture of goods because we don't have as many people working. We're having trouble getting ships into ports and all these things. So it's restricting supply. And then there's more money out there. So then it's natural that prices are going to go up. And Milton Friedman talked all about that. And then also we saw, because of the disruption in the economy, the Atlanta Fed lowered the growth expectations from over 6% in the fourth quarter to 0.5%, which is a dramatic change, dramatically down. And so we've heard this term called stagflation, and that would include inflation with a stagnant economy. Up until recently, though, we've had a growing economy, a recovering economy. But in this quarter, it looks like we're having stagnation because the economy is slowing down. So now that we might be in the middle of stagflation right now. So we'll see where that goes, Chris.
Yeah, I mean, I think that, like you said, exactly. I mean, I think the inflation problem isn't easy to solve. I think there's a lot of supply chain issues, and this isn't just in the U.S., it's global, that's for sure. But, there are things that I think can be done to help alleviate certain areas of it. But I think we're probably stuck with at least decently high inflation, at least for, the near term. until we see some of these supply chains really kind of start to iron out. And I think it's going to take a while. I mean, it's a bottleneck. We need the ports need to catch back up, and it's going to be, maybe a year, maybe 2 years, who knows?
Right. Well, and then the other discussion we were having was about the oil and energy prices. It's obviously affecting China, as we talked about before. The Biden administration, within 1 day of being in office, closed the Keystone Pipeline, put 11 to 12,000 people out of work, but also dramatically changed the amount of oil that's getting into the economy at a certain lower price. So now prices to ship oil on trucks and trains and things like that are more expensive than the pipeline. And so now there's rumors that it's called pipeline number 5 that comes in from Canada through Michigan is also going to close. So we talked about, the supply and demand effect. And when supply is restricted and the curve moves to the left, well, then all of a sudden prices go up in the curve. And so that's exactly what we're seeing. Now, there's been a discussion about how it's OPEC's fault. And in fact, Energy Secretary Jennifer Granholm was on all the TV shows this weekend talking about how it's OPEC's fault and why we need to get them to put more oil out there. They're being stingy with their oil. They want to keep prices high. Well, I don't think it's actually OPEC that's done any of that. They have capacity and they have the power to do something, but we're the ones that also have the power to do something. And we did it the opposite. So some member of the Biden national security team said, they should be using their oil to reduce oil prices, but they're really in business to make a profit. So they're trying to do the best they can for their investors as well. And that probably doesn't make sense for them to do that. By us restricting supply, primarily the United States caused that problem. We were the largest energy producer in the world. We probably won't be when this year finally comes in as the numbers come out. But there's a mismatch, as they say, between supply and demand, but it's not caused by OPEC. It was caused by our own people. So it's really quite a shame. Now, you may believe in the views of what they did, and you may have a political view that that's important to restrict oil, but nonetheless, to blame oil on OPEC is a mistake. If they believe that oil prices should be higher and oil production should be lower, then just say that. I wish they would just say that, but they don't want to say that. They think it would be politically difficult. So they're not being straight with us, I believe. Don't be fooled by what they said, because it isn't really necessarily true.
Well, and I think that, what this administration has done, I mean, obviously they have, an agenda to try to move away from fossil fuels and to more renewable resources. And, I think, if you fast forward 50, 100 years from now, that's the way things are going to move. But, I think we also need a plan in that direction. And the plan can't be just to cut everything off immediately and try to, get there in 2 years or 5 years. And I think, the issue that I see with it specifically is, by going in that direction, it's really going to have the biggest impact on the lower middle classes, because those are the people that can't afford to maybe spring up and get like a hybrid car or an electric car, or, these things cost a lot of extra money, in some cases, $5,000 extra to go from a regular car to a hybrid version. So, these are people that can't afford that. So they have to rely on gas prices. And when gas prices go up to $5 a gallon, it really hurts, and it really hampers what they, how much they can travel and what they can do and where they can spend money. So, I think that the plan needs to be better, worked out as far as what the transition will be. And as, alternative resources or alternative energy comes online, then to start drawing other things down. So I just think they're trying to force too much through too quickly, and there's not a thought given to the impact it's going to have financially on, and specifically on, the lower middle class.
And many Americans and many people in the world community believe that clean energy, whether it be solar or wind or electric, is better for us overall. And you can have that opinion. I believe that. I believe it's a good thing. But to do that overnight would be so disruptive. And it seems like they're trying to do something like that a lot quicker than the market can really handle it. So there are now that oil goes to 125 or even breaks the previous high in 2008 of $144 a barrel. And we would really hope that's not the case. but that could take oil prices well into the $6, $7, $8, $9, $10 a gallon number. That would be very dramatic. Just by way of reminder, the 70s oil crisis, when oil prices, West Texas Intermediate crude, trading at $3 a barrel, then overnight, literally within 2 days, went to $18 a barrel, would be a six-fold increase. So if we're at $80 a barrel right now, it would be the equivalent of oil going to almost $500 per barrel. And then that would, oil prices would soar, gasoline prices would soar. So even if we see them go into the mid 100s, it's going to dramatically change the input cost of energy for all Americans. They already see those prices in Europe, and now we're starting to approach European prices at the pump, which is really pretty scary.
Yep, it is very scary.
So moving to China needs coal, another energy story. And because they really don't have enough coal in China, they are closing plants sometimes 1 to 2 days a week because they can't afford the local coal. And it seems like an easy thing to do to trade American coal for goods. But again, if you're against coal energy, you don't do that. And I think that's what the administration is doing. So everyone's restricting coal. The Chinese economy is slow. We're seeing input prices go up. So, it's a really difficult time for China. It's a difficult time for Asia. And now it's becoming increasingly a difficult time for America. So.
Yeah, we're seeing, I would say, it's almost global, right? We're just seeing things are really tightening around the world. And, it'll be interesting to see what the monetary policy looks like. Because like I said, inflation is not something that's just in the US. And I think with the origins of it being from an energy and supply chain issues, it's going to impact the global market. So, we could see tightening in the EU as well. It'll be interesting to see how the different, economies and monetary policy of these different nations react.
Yeah. Well, let's move on to the What We See Out There segment. We were looking at some discussions recently about Bitcoin, Chris, and now we have two mayors new Mayor Adams in New York City, and the mayor of Miami, who said they're going to take their first salary in Bitcoin. So we've said this all along, that until Bitcoin is something that's in our pockets, that we spend when we go to the grocery store or the gas station, that's actually a currency. So until it's something that we actually use every day, it's not really a currency. And if it was a good currency, it wouldn't be so volatile as it is right now. The dollar is not that volatile. All the other currencies aren't that volatile. But maybe this is a sign. The two mayors taking their salary in Bitcoin. Although I hope they convert it to cash quickly, because it's pretty volatile, isn't it?
It's extremely volatile. Yeah, I think that Bitcoin, I don't know if we'll ever make it to being an actual currency as we use like the dollar for. But I look at Bitcoin more as like gold, as whereas it has some sort of value. A lot of people have talked about it as a hedge for inflation, because it is volatile and it does obviously move up very quickly, and it's uncorrelated to the dollar for the most part. So it's going to be interesting. The volatility on it would need to go to be essentially non-existent from where it's at now levels for it to become a currency. And we'll see, but that goes a long way. I think, I don't know what to make, if that's a good thing or a bad thing if they want it in Bitcoin, because you would imagine them being the mayor, they'd have faith in the U.S. government and the dollar. So I don't know if that's pessimistic on their part view.
Well, maybe the mayors don't need their money that much, but they probably ought to convert it to dollars pretty quickly. Chris, you saw something about this new electric car company in China, right?
Yeah. So interesting, kind of talking once again about electric and energy. So Rivian is kind of the biggest new IPO that's making a lot of waves out there. So they're being compared to Tesla. Some people are speculating that they're going to be the new Tesla, and off of that, they jumped almost 30%, 29% on its IPO on the day of its IPO. And it's up an additional 16% since it IPO'd on Wednesday. So, we're seeing a lot of speculation out there now as investors, try to make bets. And, I think it's really interesting. We saw this play out in the cryptocurrency market for a while. And we're certainly seeing it play out maybe in the stock market. People are, you have a lot of investors that are trying to find a new or an unknown stock, or in the cryptocurrency's case, cryptocurrency, and make that bet early, hoping that it's going to go to the moon. And I think that's maybe a sign that we're at that point where you have rampant speculation going on out there, and it'll be interesting to see how it plays out. It's appreciated so much, you could easily state that it's overvalued. It could easily come crashing back down, but only time will tell.
Well, I do remember a podcast episode we did before with Angus Baker, where he talked about all the gas and oil that's involved in creating electric cars. So while we can certainly convert emissions to being minimal because of electric, there's still a lot of energy expended to create an electric car. Anyway, we'll see how that all goes, and we'll see if it has the impact everyone expects. The other last thing I wanted to talk about was there was the climate summit in Scotland, and unfortunately our president got caught sleeping on the job. I think he was napping for 9 minutes, and of course the press made a big deal about it. But the more interesting thing was that China was a no-show, and they sent a short statement saying that we need to adopt climate solutions multilaterally, meaning between all countries, while they are reopening their coal plants and recommending others close their coal plants. So China, they need more coal, so they're kind of ignoring all the general climate views that people don't want to burn coal. Coal is not clean. Clean coal has turned out to be an oxymoron. And China, everyone believes would never really meet the promises that they make. And in previous climate agreements we've had, America has agreed to major restrictions and allowing other countries of the world many, many decades to get to that same level. So it's moving in that direction. Everyone wants a clean climate, clean air, clean water, but it's not being organized as equally among all the countries as everyone probably would like. So, we're probably of the opinion that China will use the climate regime to take advantage of that and try to take advantage and take market share from countries that are unilaterally cutting their emissions and therefore for increasing their costs. And so China would take a cost advantage and take advantage of that. That's what we think will probably happen, but who knows? But another big climate summit was held, and a lot of good things were discussed. But no complete resolution, that some of the big players weren't even there. So, Chris?
Yeah, no, I mean, I think that, the global warming or this climate problem, I think the key is it's global, right? We all, everyone's got to cut. And I think, just by nature of their populations, India, China are going to be the biggest ones that have to, make cuts to their output. So I don't know. Who knows? You'd hope, but I don't foresee China kind of making that sacrifice, if you will, for the global good. And India is still very up and coming, and I think it's going to be hard for them to make those sacrifices as well. And then I think you have the outlier in OPEC, who's pretty much come out and said they weren't, going to, or they don't see at this time, they said kind of the politically correct way to deviate away from, oil or fossil fuels. And I don't see Russia either. So, it's until they find kind of a resolution for this, and whether that is, a concerted effort of all the other nations, tariffing them or something, until it escalates to that point, I find it hard to believe that some of these countries that have huge economic inputs really, and huge economic outputs from these cutting it or doing anything with their production of oil or any fossil fuels.
Yes. Well, Chris, thank you. And since the last podcast, we had an election. It was a midterm, not a midterm even. It was an interim election. There were a couple of governors' races, New Jersey and Virginia, and most of the action happened on the Republican side. And I would say that Clearly by the president's poll numbers, his poll numbers are very, very weak. There's more and more concern about the economy, about the border, and certain things that are going on politically. And whenever the president is weak and our leadership is weak, it affects the economy, it affects what people think of us, it affects their willingness to work with us. So we want things to get better. We hope things get better. As we talked about years ago when Brexit happened, and then with the election of President Trump, there's times when the politicians are not listening to the people. And when they don't listen to the people, then the people rise up and go in a different direction. And we think that's what we saw that election night. And then we'll see how that plays out in the economy. Certain states now are going back to more capitalistic freedom policies as compared to things that were going on during the pandemic. So politics and economics are always intertwined for sure. And we saw kind of a big sea change that night, on election night. So maybe that sea change will continue into 2022. Many of the policies of the current administration are not well liked by the economy, although the markets keep going up, and we think that, as Milton Friedman said, is a monetary phenomenon where there's just so much money out there chasing assets, so the markets keep going up. So we hope the markets continue to do well over time, and we don't see a big decline. But everyone should be ready. There always are pullbacks in the market. We should be prepared for that. Not that we should be worried about it, but we should certainly be prepared and ready at some point for the market to either correct or go into a bear phase at some point. So anyway, right now things are all on offense. Things are moving in the right direction, at least in the markets. Economy will be weak this quarter. We'll see how it all shakes out. Chris, I think that's all I have today.
Yeah, no, I think that about covers it.
All right, well, let's leave it there. And thanks everybody for our whole 4-star team. We have Laura, Chris, Christine, Fred, and Jack in Chicago, our East Coast team, Tucker, Karen, Brian. Thank you for being with us again on the 4-star podcast, and have a great weekend.